really looking forward to Ted's session this morning. So I worked with Ted, it must be, oh, I don't know, 10, 15 years ago, maybe even longer, when I was at Nationwide Building Society. And Ted joined us. He used to run absolutely phenomenal, brilliantly rated sessions for our high potential individuals, for our senior execs as well. I think it was global macroeconomics and a couple of other topics as well, helping people talk financials. And Ted has been in business for, well, the last 20 years, actually, working with a number of different organizations. I think it's over 300 organizations across 35 countries, isn't it, Ted?
That is right, absolutely.
Yeah.
36 countries now. Just went to Jordan a couple of weeks ago, so
lovely.
The tally continues to increase.
Off to Palestine this weekend, apparently, as well. So he's very well traveled. He has got so much to share. So I'm going to stop right there and hand straight over to Ted.
Excellent. Okay, so thank you very much indeed, and welcome everybody to Building Commercial Savvy. We have one ad. In fact, we have 57 minutes left on the clock, so let's jump straight in. If you consider the P the company trades at, look at its operational and financial gearing, you will be clearly asking yourself whether the treatment of goodwill under UK GAAP or US GAAP is appropriate, whether FRS 17 is relevant. I mean, should we hedge our forex exposure? I agree. I flex the budget, analyze the leverage against the original internal rate of return, which has changed materially. It's a question of liquidity and use of balance sheet, off balance sheet finance. If you ask me, I suggest we accrue our costs, capitalize a project, amortize goodwill, and defer the income. What should we make the profit figure this year? Now, if you're sitting there looking at me a little bit like Lara and Anne and Nicola and thinking, I have no idea what these guys are talking about, it's okay. This workshop or this session is all about kind of lifting the lid on that business finance and understanding exactly what they are talking about. It was Warren Buffett who said accounting is the language of business. If you are in business, you need to be able to speak finance. It's no point. You can leave marketing to the marketeers, you can leave operations to the operations, you can leave facilities to the facilities management, you can leave IT to the IT, but everybody, as you progress through an organization, needs to understand the language of finance. And that's really what we here at Talk Financials are all about, teaching that language of business. So what are the objectives of this session? Very simply, to demonstrate the importance of learning the language of business finance, to show you how being able to read and interpret financial information will help those in operational roles to make informed judgments and decisions, and hopefully to learn something new. Always good when we can learn something new. So those are the objectives of this 1 hour little kind of workshop. Much more importantly, there is your objectives. So I think we've got about 5 people on the call. So what I'd like you to do is to use the chat and tell me, first of all, on a scale of 1 to 5, how commercially savvy do you think you are? Okay. Now, this is not a kind of benchmarking against anybody else. This just gives me a feel for whether you feel very comfortable with numbers. Maybe you're up there with Warren Buffett, balance sheets, cash flow statements, income statements. That's your bread and butter. Or maybe you're like my wife, who has decided that if you don't open the envelope, you can't be overdrawn. So I have lots of unopened bank statements lying around at home. And then anything specific that you would like me to cover from this session. So, maybe you've heard this word, I don't know, EBITDA, and you're not sure what it means. Maybe you're worried about the spread on the Italian government debt, and that's keeping you awake at night. Or maybe you just want to be a sponge, soak it all in. Ted, I don't even know what I don't know. You tell me, and I'll take it all on board. So we got quite a few. We got a 3, a couple of 2s, another 3, and then a very honest 1 in there, a 1 and a sponge, and lots of sponge. EBITDA would be good. So a couple of EBITDA is sort of coming up as a common request. Okay, so we'll cover EBITDA during the session. Excellent. Okay, so there we go. If you do have any questions, if you're on the call, you can use the chat. I'm not very good at using the chat, so much better just unmute your microphone and talk to me. Interaction is key, and I will be asking you questions as well, just to keep you on your toes. I'm not trying to catch anybody out, but it makes it a little bit more interactive. And just one little caveat, I have my wife is out at the moment and she's looking after some neighbors' dogs. So we have the most phenomenally large neighbor of dogs. And I know if the Amazon man comes calling or the postman comes calling, it's all going to kick off in the background. So I just apologize in advance. That will probably happen just when it isn't meant to. Okay, so there's my kind of caveat of working from home. But then we're used to that, aren't we? The cat decides to kind of show our office its rear end right in the middle of that really important strategy presentation. So just to introduce myself, my name is Ted Wainman. I am actually a chartered accountant. I've spent 6 fun-filled, happy-go-lucky years with Ernst & Young, a small bunch of cowboys some of you will have heard of, where I trained and qualified as a chartered accountant. Don't get me wrong, I enjoyed my time at Ernst & Young, particularly the exams. In fact, I enjoyed the exams so much I sat most of them twice, some of them 3 times. Anyway, after 6 years as an accountant, life was too exciting. I had to leave, so I downshifted my life and I joined JP Morgan, a small bank some of you may have heard of, where I did another 6 years on the investment management side. Did an MBA there, stands for More Bloody Accountants, but I finally escaped in about 2003, and since 2003 I've been designing, developing and delivering training workshops. As Katy mentioned, I've worked with over 300 companies in 35 countries around the world, in fact 36 now, and I'm also the author of a book called How to Talk Finance. So I do a lot around finance strategy, but I also do sort of leadership, management, communication, influencing, persuading, etc., etc., etc. And my aim of any workshop is to make it as relevant as possible. So I'm often going into my clients, I'm pulling up the accounts of their organization, their competitors, their suppliers, their customers, and really helping people to kind of, to show how much information is contained within a set of financial statements. So what is accounting? Accounting is the process of identifying, measuring, and communicating financial information to permit the informed judgments and decisions by users of the information. Okay, now it's the bean counters, the finance guys, they do the identifying, measuring, and communicating. Okay, so this is not an accounting workshop. This is not double entry bookkeeping and debits and credits and trial balances. But you guys in the business need to make informed judgments and decisions. And the financial information you get, the budgets you've prepared, the actual information that you're receiving is helping you to make those informed judgments and decisions. You can only make those informed judgments and decisions if you can read and interpret the financial information you are being provided. And therefore, I kind of liken these workshops to a language workshop, okay? And you're not going to be fluent in finance in 1 hour. You're not going to be fluent in Spanish in an hour. And if you did a 1 hour Spanish workshop and then put nothing into practice, you will forget everything very, very quickly. So what I want you to think about as we're going through this hour is what are the things that you can kind of take away? What are the things that you can apply and apply on a regular basis in order to retain the knowledge that I'm hoping you're going to get over the next 50 minutes? So the way we're going to run this is a little case study. So this is not the kind of typical way I'd usually do a kind of a finance workshop. We usually start with the basics. We put in the building blocks, look at the basics, look at the key financial statements, and then look at reading and interpreting. But because we got such little time together, we're going to turn it right around. So here's a scenario for you. You have a meeting with your boss at the offices of a potential supplier in about half an hour. So we've got about 30 minutes, 40 minutes in order to do this exercise. The supplier is potentially going to be supplying a key element in your supply chain. So we're really keen that these guys are going to be, they're a sound, solid company, that we like them. They're going to be around for a while. And we need to make sure that they are a safe company. So we're not looking for kind of a one-off transaction. We're looking for a long-term relationship with these guys. Your boss has managed to obtain a copy of the company's accounts, but has not had time to review the accounts. They've asked you to have a look at the numbers and meet them at the supplier's offices. So what we're going to do is we're going to look at these and we're going to think about, would we put these guys in our supply chain, and also what advice we would give the directors. Now, we're giving this as an example from a supply chain, but this is relevant whether you are running your own business, whether you are working within an organization, whether you're a salesperson looking at a potential customer, procurement, looking at a potential supplier, or anybody else involved in sort of budgeting and reading financial information. So here we go. Let's jump in. So this is my company. It's called the Case Study Limited. It is actually a real company, but the names have been changed to protect the innocent. So here we go. Let's start off. Hope you're all ready for it. Anne, can you tell me, what are the sales of this company? What are the sales of this company? Now, it's a little bit of an unfair question because Anne's going, oh, what sales? And you can't see the word sales, but sales is also known as income or revenue or turnover.
So for this year, it's
this
the
year,
14,696,742.
Exactly. And you'll notice that we're dealing in pounds, and therefore the revenue or the sales is about 14.7 million pounds. Okay, so these guys, 14.7 million pounds. And and I'm explaining here that, turnover, sales, revenue, income, just like any language, we have multiple words which all mean the same thing. So the Eskimos will have multiple words for snow, and the Hawaiians will have multiple words for wave, and the English will have multiple words for rain. Okay, it's just a reflection of the culture. So here we go. Here's our turnover, and you'll notice, Nicola, what's happened to sales from last year to this year? Have they kind of about the same? Have they gone up or down?
Sorry, they've gone up.
They've gone up. They've gone up massively, 62%. Okay, that's a phenomenal increase in sales. Here's the gross profit. So the gross profit is the sale less the cost of the thing that we're selling. So for example, if we're selling these glasses, for example, and we're selling them for £5 each, the cost of sales is the cost to us of these glasses, of buying these glasses, or perhaps of making these glasses. So maybe we're buying the lenses, we're buying the plastic bits, we're putting them all together, packaging them up and sending them off. That's all the cost of sales. Okay, this cost of sales is generally known as the variable cost. If I sell these glasses for £5 and they cost me £1, the more glasses I want to sell, the more glasses I'm going to have to buy or make. So this cost of sales is generally seen as a variable cost, which means that the more glasses we sell, the more glasses we're going to have to buy. And therefore we see this gross profit. This is about 25%. So 3.6 million is about 25% of the 4.7 million. And that 25% would be known as the gross margin. So a margin is expressing the profit figure as a percentage of the sales figure. Now, interesting enough, with this company, we'd expect the gross margin to stay constant. This gross margin has actually dropped from about 33% to 25%. We're not sure why that is, but that might warrant a little bit of further investigation. We then deduct the costs of running the business. Now, Lara, what do you think might be in these other operating charges? So if I'm running a business that makes and sells these glasses, what other costs do you think a company might incur?
Salaries, the materials, shipping.
So the materials are in here. So the materials are part of cost of sales, but the shipping is operational costs. The salaries of the people making the glasses are part of cost of sales, but the salaries of the board of directors, for example, is operating charges. So when we think about running a business, you're absolutely right there. You've identified some pretty good ones there, Lara. So thinking about marketing, sales, HR, the finance team, the facilities team, IT, board of directors, the board of directors Learjets, the board of directors golf memberships. I'm joking, of course. But all those costs, rent, rate, light, heat, subsistence, travel, training, all those costs of running the business are in the operating charges. So we have these two distinctions here. So we have the cost of the thing that we are selling and the cost of the business that is doing that selling, of running that business. And those are the two main distinctions there. And if we deduct all of those costs, we get down to the operating profit. There is the operating profit. Okay, so that's basically our kind of our operating account. That's the cost of, that's the profit we make after running the business. Now we've got a couple more key categories of costs. The first one is this here. Okay, this is the interest payable. Now, why do we pay interest? Rebecca, I can see your camera's turned off. I'm not if you're on the call. So Rebecca, do you know why we might pay interest? Oh, I can't. You're very low on the volume,
Oh,
Rebecca.
sorry, is that better?
Oh, there we go. You're back in.
I was eating my porridge.
That's all right.
I'm not 100% sure, if I'm honest.
Okay, so let's try this. Rebecca, do you pay interest?
Yes.
And why do you pay interest, Rebecca? What do you have that causes you to have to pay interest?
It might be things that I pay over a period of time on direct debits. We pay interest on, so loans and yeah, as Sonali's just popped in the chat there, just as I said it.
Absolutely. Exactly. So if you have debt, you will pay interest. So if you have a credit card, for example, and perhaps you don't pay off the balance in total, you'll be paying interest on that balance. Good idea is to actually pay off the balance. If you have a loan, if you have a mortgage, for example, you will be paying interest. So when we look at this company, we say they're paying interest. They've probably got some debt on their balance sheet. They've probably got a loan. That's what I'd expect. And the last category of cost is tax. Anne, do you pay tax?
Yes.
Yes. Okay. There are two things in life which are guaranteed. Two things in life which are guaranteed. Anne, do you know what they are? Death and taxes. There you go. So we all pay tax, and we're all going to die at some point. That's very morbid. Those are our four key categories of costs, just to remind ourselves. So we've got the cost of the thing that we're selling, the cost of the business that is doing that selling, the cost of any debt that we have, and the cost of the tax, which is the cost of doing business in a certain jurisdiction. And taking our revenue and deducting all of those costs gives us our net profit, sometimes referred to as the bottom line, called the bottom line because it appears at the bottom. The top line is, of course, our sales figure that appears at the top. So the profit for this company, £670,000. So they're making turnover at 14.7 million, profit 670,000, not a massive margin, about 4.5% margin, but they are profitable. So gut feel right now so far, Sonali, do we like this company? Do we want to do business with this company?
So I guess my question would be is why their profit hasn't gone up when their income has?
That's a very good question. Okay, so we'd have to investigate a little bit more, but it looks to me like, so I mentioned here, their gross margin has fallen from 33% to 25%. So this is 3 million divided by 9 million is 33%. 3.6 million divided by 14.7 million is about 25%. Now, we haven't got time to go into sort of full detail, but the two reasons that a company might see its margin fall would either be that the sales price is dropped, squeezing their margin, or the cost of what they're selling goes up. So if we buy these glasses, if I buy them for £1 and I sell them for £5, that's making a £4 profit. £4 profit on a £5 sale, 80% gross margin. If I then drop the sale price to £4, I'm only going to make a £3 profit. 3 divided by 4 is about a 75% gross margin. Or the cost of these glasses goes up to £2. I buy them for £2, sell them for £5, £3 margin, £3 gross profit is a 60% gross margin. So what we're seeing here is that this company, they're growing. It looks to me, and this is a guess based on the numbers, it looks to me that 60% increase in sales, That's pretty punchy. I reckon they've dropped the price. I reckon that they're trying to drop their price and gain market share. And as a result, you're absolutely right, Sonali, they're sacrificing margin. They are not as profitable in percentage terms as they were last year. The absolute profit has gone up, but the profit in percentage terms has gone down. So that's fine. That's, that's their strategic decision. That's fine. Grow a company, drop the sales, grow, and gain market share. Maybe the price will be able to come back up again once they've established themselves in these new markets. Perhaps, I don't know. But looking at this company, it's profitable. It's not making a massive amount of profit. I'm looking pretty comfortable. I quite like this company. Now, just a couple of one more thing before we move on. So this interest they are paying, we said that this is a function of the debt they have and the interest rate. Nicola, who sets the interest rate? Who decides on the interest rate you're going to pay? Oh, you've lost the unmute button. I can see you hunting around for it. Who decides the interest rate you're going to pay? Or are you in the chat? Sorry, I haven't got the, here we go. So with the Bank of England, they set the base rate. You're absolutely right. But then it's the lender. So if you borrow money on a credit card, for example, you're paying 40%. Okay, the Bank of England don't set that. It's the credit card lender who sets that. So it's the bank. So the only way to pay no interest is to go debt free. Anybody here got a mortgage? Anyone here got a mortgage? Yeah. So Anne, you've got a mortgage. Anne, could you go debt free this time next month?
No.
And pay no interest. No, says Anne. And you could, but what would you have to do?
Win the lottery.
Or
more
realistic, sell your house. Sell your house, pay off your mortgage, you're debt free. Easy as pie. Why don't you just sell your house and go debt free, Anne?
Well, I want to stay owning a home. I don't want to rent a home.
Exactly. And you need somewhere to live. Okay. So Anne is saying, Ted, this is crazy. You have no idea what you're talking about. Listen, I've made a long-term decision to buy the house and I've used the debt in order to fund the purchase of that house. Exactly the same way that this company has probably borrowed the money to buy the assets in order to fund its business. It could repay that money, but it would have to sell the assets. So if we think about it, Lara, do you have a table in front of you?
I do.
Okay, I can't see whether you're at home or in the office, but let's assume you're in the office.
Yeah, I am.
You're in the office. So could your company sell that table and turn it into cash?
Not if they want. That they could do, but they'd have to send us all home. Yeah.
Exactly, because Lara would say, hold on a sec, I need the table because otherwise, where else do I put my feet? I mean, my coffee or my laptop, for example. Yeah. So what you've got here is you've got things like Anne's house and Lara's table, which are things that the company needs to run the business. And they've probably, they could well have borrowed money in order to buy them, and they could pay off the debt, but then they'd have to sell the table or sell the house. And they don't want to do that. So really, when we look at a company like this, we say, look, they can't really affect the interest in exactly the same way that Anne can't really cut her interest bill. It's there. It's just a given. And we were also talking. I feel I'm picking on you, Anne. So tell me if you're feeling picked on, and I would go and pick on somebody else. So Anne, we were also talking that you were paying tax, and you I could almost see the tears, from the all the tax that you have to pay. Anne, would you like to pay no tax?
Yes, I'd love to pay no tax.
Okay.
Yeah.
Okay, so here we go, and this is the way you pay no tax. Now, this is a perfectly legitimate. This is not a Jimmy Carr kind of scam. Okay, this is the legitimate way, the TED way of paying no tax. When we have finished the call, Anne, phone up your boss, tell him or her that you will work for no money, because if you earn no money, you will pay no tax. Is that the best piece of advice you've ever heard?
No.
No, exactly. You're taking the rubbish, Ted. So basically, what Anne is saying is, look, I pay tax because I'm earning money and the tax rate is set by the government. This company is paying tax because they're making a profit and they have to pay it. That's set by the government. They're paying interest because they've got some debt and they have to pay that interest. It's set by the bank. And therefore, they're saying, look, can you judge me on my earnings before interest and tax, known as operating profit, or EBIT for another word, earnings before interest and tax, EBIT. Now we're getting closer. Lisa, what is depreciation? What is depreciation? Oh, you've just gone blank on me, Lisa.
Hi, if I come back.
What is depreciation? Yeah,
Depreciation.
there you go. I can see you now. What is the? Yeah.
So is it if I bought a laptop, it was brand new, it would cost more than over the years, it would lose its value?
In effect, yes. So
Yeah.
we have to be quite careful about this losing its value. But if we say, if you buy a laptop for, I don't know, let's say £1,000 and you intend to use it for 4 years, that's the equivalent of £250 a year. And therefore we would depreciate it at £250 a year. Now, after 1 year, it might not be worth £750. Okay, so we have to be careful. It's not market value, but it's it's an allocating the cost of something to what we call its useful economic life. And so therefore, if you buy this laptop for £1,000 and you use it for 4 years, the depreciation charge in your accounts will be £250. That's a function of the cost of the laptop and your depreciation rate, 4 years. The only way to remove that £250 from your account, the only way to save that money is to not buy the laptop. And Lisa would go, well, hold on a sec, Ted, that's crazy because I need a laptop to do my business. Okay, and therefore for a company with depreciation, and the depreciation for this company is going to be somewhere in here and somewhere in here. We can't actually see it at the moment, but we know it's in there somewhere. But the depreciation is the depreciation on their assets that they need to run the business, exactly the same way as Lara needs the desk that she has in her office, and Anne needs her house, and Lisa needs her laptop. Rebecca, have you ever heard of amortization? Have you ever heard of amortization? No. Has anybody ever heard of amortization? Okay, no reason why you should do. Amortization really is depreciation by another word. We depreciate tangible assets, which are things we could touch, like tables and chairs. That's just turned my, I don't know why, it just tapped on my table and it turned my video off. I'm not sure what's going on there. So we depreciate tangible assets. We amortize intangible assets. Intangible assets are things that you own, but you cannot touch. Okay, so an example there would be intellectual property rights, licenses, patents, etc., etc., etc. So if you're a telecoms company, you'll have a 3G license or a 4G license that you bought, and that license will be an intangible assets because you physically can't go and touch 4G. Now, you can't control depreciation, you can't control amortization. So EBITDA is the earnings before interest, tax, depreciation, and amortization is in effect our controllable profit. It's the profit I can control rather than the profit I can't control. So I liken it a little bit. So when I'm in a workshop, often I'll get feedback forms at the end, and the feedback form will say, is Ted any good? And everyone will say, yes, he was brilliant, apart from a few people who say, no, he wasn't. But then I usually have a bottle of Tipex just to kind of correct all of those kind of errors. I'm joking, of course. But then they might say, what was the coffee like? Now, if I'm running a workshop for Katy and she phones me up and says, Ted, this is absolutely rubbish. The coffee provided by the hotel was awful. We're not paying your invoice. I'm going to go, well, hold on a sec, Katy. That's not my fault. You have to judge me on what I can control, not what I can't control. And in exactly the same way for a business, EBITDA is basically saying, judge me on the profit I can control rather than the profit I can't control. I can't control the tax. It's a function of making a profit and the country I'm living in. I can't control the interest. It's a function of my debt and the interest rate I'm paying. And I can't control my depreciation and amortization. It's a function of the assets I've got and how long I'm going to be using them for. So there you go, EBITDA. A couple of you asking what EBITDA is, and hopefully you're feeling enlightened. Ted, now I know what EBITDA is. It definitely puts you at the top of the ladder, because I meet a lot of people who go around talking about EBITDA because everyone else is talking about EBITDA, but they have no idea what EBITDA is. Okay, all good. Any questions so far? Everyone's happy. Excellent. Okay, let's keep going. We've got 28 minutes left on the clock. We're going to now look at this company on the balance sheet. Now, if the income statement is my trading account, shows my sales and my costs, my balance sheet is a kind of my financial strength, shows my assets and my liabilities. Assets, things I own; liabilities, things I owe. So finance is really, really simple. We've got sales and costs in the income statement, assets and liabilities in the balance sheet, and that's it. That's all there is to finance. Remember, finance is a simple subject made complicated to justify the fees. So let's look at the assets. So we've divided the assets into two types. These are the two types here. We've got our what's known as non-current or fixed assets and the current assets. Now, the non-current assets up the top, the fixed assets, these are the things we need to run our business. So Anne's house, Lara's table, Lisa's laptop. These are the things we need to run the business. The current assets, on the other hand, are things like cash, debtors. Rebecca, can you remind me, what are debtors? People who, what's this number here? Debtors.
But
you ever heard of?
so that's like that's your loans, isn't it? What you've borrowed.
That's a good guess, but no, that if it was
who
debt,
you owe, it's who you owe.
Well, it's not who you owe, because it's an asset, so it's very close, but it's who owes you. Debtors are people I've sold things to, I've sold the glasses to, and I've sold them and said, you pay me later. Okay, and so you pay me later means that they're going to pay me a little bit later on. So these debtors are people who owe me money. And here we've got stock, and stock is all the glasses sitting in the warehouse, work in progress, and raw materials. What am I trying to do to the glasses in my warehouse, Sonali? What am I trying to do to the glasses in my warehouse?
Trying to sell them.
Trying to sell them, exactly. Okay, and if I sell them, I'm going to sell them on credit, because that's kind of the way I do business. None of this, you know, I'm not kind of HRH Prince Charles with kind of bags of cash being passed from person to person. That's a bit of a topical in joke at the moment. So it's all on credit. So I sell my bags. You pay me later. So the stock will turn into debtors, and the debtors will turn into cash. And therefore, current assets. This word here, current. You can see. Let me just move my, here we go. So the current assets are things I own, which are either cash or going to become cash soon. Okay, so two types of assets: things which I own that I need to run the business, which are my fixed assets like tables and chairs and plant machinery and equipment, and then things I own which are either cash or going to become cash soon, my current assets. Any questions on the assets side of a balance sheet? All good so far. Okay. Liabilities, we split our liabilities between what we owe and we have to pay within a year, which is basically I've got to pay soon, and what I owe and I don't have to pay within a year, I've got to pay later. So, for example, if you've got an unpaid phone bill sitting on your desk, an unpaid water bill, an unpaid council tax bill, an unpaid credit card bill, I'm going to stop there because I'm just depressing you. Those are going to be your creditors' amounts falling due within 1 year, your current liabilities, things you have to pay soon. Anne's mortgage, luckily, Anne doesn't have to pay all of that soon within a year. Most of it's going to be paid next year, the year after that, the year after that, etc., etc., etc. Okay, and therefore Anne's mortgage would be in here in the non-current or the long-term liabilities. And for any business, if you take all of the assets and all of the liabilities, and you deduct the liabilities, which is this number here and this number here. So if you take the assets and deduct the liabilities, you end up with what's known as the net assets, which is the 2826. The net assets as the assets net of or less the liabilities. And if we put this company into liquidation and we close the business down, we would take those net assets and we would give them back to the shareholders. And so for every business, the net assets is equal to the shareholders' funds. This is known as the balance sheet, and the clues in the name is because the balance sheet balances. So for every company, the assets less the liabilities is equal to the shareholders' funds. It's the money that's left over that we give back to our shareholders. Now, the important number here is looking at these two numbers here. This company has about 7.8 million pounds of things which are cash or going to become cash soon. It's got 5.2 million pounds of amounts that it has to pay soon. Okay, so 7.8 either in or coming in, 5.2 going out. Is that ratio good or bad? Gut feel, Lisa, what do you think? Is that a good ratio or a bad ratio? 7.8 million of cash or coming in as cash soon, 5.2 million of which has to be paid out soon.
I mean, it's good that they've got money to cover the outgoings.
Yeah, exactly.
But,
and this is known as the liquidity ratio. So it's known as the liquidity ratio. It's a 1.5 or 1.49 if you were to calculate it, and just tells me that these guys, they can pay their bills on time. Okay, and that's a really, really important ratio for a business, because if you can't pay your bills on time, Nicola, if you don't pay your staff this month, what will they not do next month?
Oh, sorry. They won't turn up.
They won't turn up. And Nicola, how quickly will your business cease to trade if your staff no longer turn up?
Straight away.
Exactly, pretty much straight away. So now what's interesting about this is that most people in a business will not see this ratio because they're looking at the income statement. So most people, they're doing their budgets, they're not looking at this kind of money in, money out ratio. But this is really, really important. This is known as a liquidity ratio. Liquidity, all about cash, and cash is king, as they say. Now, let's keep going. Any questions on the balance sheet? Any numbers there? Anything that kind of, oh, Ted, I don't know what this means or what that means.
Can I ask a quick question? Sorry, on the liquidity, what is
Yes.
a good ratio and what's a bad ratio? I mean, obviously, you need to have enough money coming in to pay for your debts falling within 1 year, but is there a sort of a buffer that we should be looking to have percentage-wise?
Yes, I mean, there's a general rule that says if you're above 1, you're okay. That's a kind of very much a general rule of thumb. Now, there are some companies who can operate at below 1, okay, based on their business model. So these are companies who get paid before they pay money out. So if we think about an airline, for example, an airline, you pay for the ticket today, but you're not going to fly for a couple of months on your holiday. In fact, they're probably going to cancel it. So, you know, you're not going to fly at all, but that's a separate issue at the moment. A telecom company, you buy your prepaid SIM card. Supermarkets are very cash generative. So supermarkets typically will operate at below 1. So there's very much a sort of an industry specific in terms of that business model. But as a general rule, I'd like it to be above 1. Once it's above 2, you're probably being a little bit inefficient. Maybe you've got too much cash. Now, I'd rather you had too much cash than too little cash. But once you've got too much cash, it's not doing anything. It's just being inefficient. And you want to get it out there working. You want to get it invested and generating you a proper return, because money sitting in the bank is, in fact, not only not earning anything, it's actually being destroyed in value by inflation.
Sorry, Ted, what do you mean by
Yes.
above 1? Is that like 1%, or?
No, about a ratio of above 1. So as long as this number here is bigger than this number here. So if you take 7 divided by 5, or 7.8 divided by 5.2, you're about 1.5. That's the ratio. If we swap those numbers around and you ended up with 5.2 divided by 7.8, you'd end up with a ratio of whatever that is, 0.7 or something, which would be below 1. So it's a ratio rather than a percentage. And it just says, for every £1 I owe and have to pay soon, I have £1 and, in my example here, £1 and 50p, either as cash or coming in as cash soon.
Thank you.
Now, what's really interesting about this, and hopefully we're not going to run out of time on this, what's really interesting about this company is this number here. So sometimes we talk about the acid test, and the acid test is exactly the same, but ignoring stock. So if we were just to put a line through this number and do the same ratio and compare these two numbers with what they owe, we can see that they've got 2.3 million as cash, or coming in as cash from the people they've sold stuff to, but they owe 5.2 million. They're very dependent on their ability to sell their stock. If they can't sell their stock, ding-a-ling-a-ling, we have a problem here. We have a problem. So this is actually a big issue for these guys, that actually they're very dependent on stock. They're very dependent on their ability to sell their stock. The next thing you might mention is, Lara, how much cash do they have?
44,000.
Okay, let's just be careful about our denomination.
Oh no, £44.
£44. So Lara, just checking, do you have more or less than £44 in your current account? You can tell me to go away in my mind.
Yeah.
You have more. That's the right answer, Lara. Thank you. So these guys, they've got £44 in the bank. That's like nothing. They've only, in fact, it's not even in the bank. They've got £44 probably in the petty cash bit. They've got lots and lots of stuff in the warehouse, but can they sell it? And they're owed 2.3 million, but they have to pay their suppliers 5.2 million. These guys have big liquidity problems. And actually, if you've only got £44 in the bank and you haven't got it in the bank, it's in the petty cash tin, what do you think you've got at the bank? If you don't have money in the bank, you've probably got negative money in the bank. Yeah. What do we call that?
Debt overdraft.
It's an overdraft. And an overdraft, do you have to repay an overdraft? Oh, don't worry about it, a couple of years' time, or when the bank manager says so, on demand.
Yeah, on demand with interest normally.
It's on demand, exactly. Okay, and so it would be in here. So this is where the notes become so important. We need to go and have a look at note 15. And here we see note 15. Look at the top line. This is the creditors' amounts falling due within 1 year. There's the 5.2 million they owe, and we can see 1.4 million overdraft. These guys have no money in the bank. At the end of each month, they phone up the bank manager and they say, please, 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 can I pay my staff? If the bank manager says no, what happens next? Nicola, you told me, if the bank manager says no, you cannot pay your staff, what happens?
Default.
Yeah,
you've got no money to pay them, so you'd have to kind of make some serious decisions, I suppose, around.
Exactly. And so what we're starting to see here is that a company that actually looks pretty good, it's growing, it's profitable, it's not as profitable as it used to be, but maybe that's part of its strategy. This company is running out of cash. They've run out of cash. So they're not managing their finances properly. And we can see that very briefly in the cash flow statement. They are burning cash. they're making negative cash, and the total cash outflow is £1 million. This company is making a profit of £670,000 a year and is losing £1 million a year in cash. And if you lose £1 million a year in cash, one day the bank will just say, no, enough's enough, no more, not interested, that's it, game over. And they will go bust. So we often hear about profitable companies that grow, they grow rapidly, they run out of cash. And what I'm starting to show you, or hopefully I'm showing you, is the fact that being able to read and interpret this financial information and able to understand the financial implications of my day-to-day operational decisions actually helps me to make the right right operational calls. These guys, they've just got too much stock. I mean, that's crazy. They've got to sort that out. They've got to reduce the stock in the warehouse. They've got to start selling it. They've got to stop buying it. They've got to get somebody in who's going to manage that stock turnover. They've got to collect this money in. They've got to get it in. And the suppliers, they've probably got to keep those suppliers sweet. They've got to look after their suppliers and say, we are going to pay you, pay your bills. Because again, if you stop paying your suppliers will stop supplying you. And again, how quickly does your business cease if your suppliers stop supplying you? So what we're showing, so I guess the first question is, Sonali, are we going to do business with this company? Are we going to put them in our supply chain?
No.
No, we're not. Okay, we don't like this company, and we're thinking that there's a few operational decisions that the directors need to take in order to get their company back onto an even keel. Okay, operationally, it's a great company, fantastic, but financially, it's a basket case. Nobody is controlling the finances. Okay, they've left it. They've got a bookkeeper in the corner who's just booking the invoices. Nobody's actually managing the finances. And this guys, they're only turning over 40.7 million. They're relatively small. So if you start to get up to kind of the millions and then the billions, you suddenly realize that actually, if you're not running the tight ship financially, you can fall over very, very quickly. And I have the privilege of looking at lots of different companies, and some of them on incredibly tight margins. Associated British Foods springs to mind from one I looked at recently. Very, very tight margins, very well-run company. Financially, a really tight ship, and that comes through in the numbers. And I often see companies which are, like this, or maybe even worse, where they're just not running that tight ship. They don't really have a handle on the numbers. And the only way you can do that is by having everybody in the business understanding the financial implications of their operational decisions, and therefore making those informed judgments and decisions. And that hopefully gives you a feel for reading, or the benefit of being able to read and interpret financial information. For most people, their initial experience of finances will be when they are asked to do a budget. They go, I don't know what a budget is. So they get last year's spreadsheet and change the date and submit it and hope that finance people go away. And then they kind of, they hear EBITDA and they hear other terminology. They kind of build up this sort of knowledge, and they're not quite sure what it is. And then they get to the board, maybe they're kind of promoted up, and they sit on the board and they suddenly realize, I can't put my hand up on the board and say, I don't know what EBITDA is. So I just have to sort of nod knowingly and say, yes, I know exactly what you're talking about, for example. And I'll give you a great example. So I'm running a workshop for a client. The finance director comes in. He says, do you mind if I just do a quick presentation before the workshop? I said, be my guest. He gave a quick 20-minute presentation. I half watched the presentation, but I really watched the people in the room. He got to the end. He said, are there any questions? No questions in the room. He then left. I said, okay, what did he just say? They looked at me, well, I don't know. I said, well, he got to the end. He said, were there any questions? And they said, well, we didn't even know what questions to ask. I mean, it was a complete gobbledygook. We had no idea what he was talking about. He might as well have been talking Japanese or Chinese. And that's exactly what we're trying to do here, is to help people to, really just to understand the questions I should be asking and give them the confidence, even if it's just to say, just to clarify, EBITDA is the controllable profit, just to clarify that revenue is in fact sales. Okay, and asking for that clarification, I think is important. So a lot of people just don't have that confidence to ask that, or don't even know what questions they should be asking. So what are we here to do? We were to demonstrate the importance of learning the language of finance, to show how reading and interpreting financial information starts to help us to make informed judgments and decisions. And I wanted you to learn something new, and we did cover EBITDA. So I hope you all feel a little bit, and I was actually chatting just before the workshop with Katy, and she said, oh, I know what it stands for, but I have no idea what it's measured or why it's important. So hopefully, Katy, you're feeling a little bit enlightened as well. I'm going to leave you with a final piece of advice, because when you are dealing with finance, it does get complicated. There are numbers flying around. And if this does happen and you get a lot of tension and you get a headache, then you should take the advice given to you on the label of an aspirin bottle. Now, the label of an aspirin bottle gives you two pieces of advice. The first one is to take 2 aspirin, which I think is pretty good advice in itself. But the second one is even better because it suggests that you keep away from children, which is really, really good advice indeed. Okay, so that is everything from me. I think, Katy, you're going to distribute a copy of the slides. I'm certainly more than happy to send out a copy of the slides. There's not a huge amount of information in there, but what I would just reiterate is, you know, as we talked about before, for me, you know, teaching people the language of finance, it's about keeping on top of that language. You know, we've done that kind of that 1 hour, but, you know, are you going to be able to retain it? There are some additional resources. So you'll see on the left-hand side the link. So the bottom left is my YouTube channel. Because I'm a very sad individual and I've got nothing better to do with my life, I analyze about 2 companies a week, and some of them are quite interesting. Some of them are pretty boring. Some of them you've heard of, some of you've never heard of. But you know, if you subscribe to the YouTube channel, then you'll get a kind of a couple of companies a week. Don't watch all of them because it's a kind of, you know, it really will kill you off. But, you know, once in a while, if you see, oh, there's a company I haven't heard, you know, haven't seen them, or I'd like to know about that, or maybe you're supplying to them, maybe you're, maybe they're a potential client, maybe they're a potential supplier to you, maybe they're one of your competitors, and you think, oh, I wonder how they're performing. Then it's about a 20-minute video, and I take you through their set of accounts a little bit like I've done just now, except we go slightly quicker. You can also access all of the videos on my website under financial analysis. I'm on LinkedIn. It'd be great to stay in touch. So there's a QR code or a link directly to my LinkedIn. Please do stay in touch. So that is everything from me. Finally, just to say, we've got 6 minutes left on the clock. Are there any questions or final thoughts for me from anybody? From anybody?
I'd just say that was really interesting. And I think what you said right at the beginning is it's practice and using it, because, you know, 20+ years ago, I did a degree in international business and, you know, with international finance and international economics, and we did all that thing, you know, everything, and haven't used it for years. And it was like looking at something completely different. I mean, doing my department budgets and everything, but that, yeah, and just following, not really looking into it for so many years. I was really quite interested.
Excellent. Excellent. So I'm hoping, Nicola, you're not thinking, oh God, that's an hour of my life I'm never going to get back. So
not at all, no. But it's good job I did have the coffee, I think.
Yeah, and I think, and your point is absolutely right. It's about it, you know. So you know, my aim is always, you know, as I talk about, it's about improving the financial fluency, to give people the resources that allow them to kind of just stay on top of it. I have lots of people who come on my workshops and they say, oh, I did a finance course about 10 years ago, can't remember anything. And I kind of, okay, well, let's go back through it again. So it really is, it's giving people those resources that they can go back, just refresh some of the key points that we're making, and then that practice, and making it relevant. You know, as I said, you know, a lot of people will use Sam Smith in his shipyard, and people sit there and go, that's all well and good, but I'm not in shipping. So, you know, if I'm in a company, the first thing I do is I get hold of their accounts. And if they rather I didn't use their accounts for whatever reason, we'll look at their competitors, their suppliers, their customers, you know, and people just go, oh yeah, that makes sense. Oh yeah, the finance director's stomping around shouting, bill your clients and collect that money. Now I know why that's so important. So it's what I love is that kind of the operations meets finance. I will sit in front of people and I will say, I'm going to tell you what I think is going on in your business from a financial point of view, and you can tell me whether I'm right from an operational point of view. And that kind of that mix, I think, is a learning journey for everybody, and we all enjoy that. So I'm glad you found it useful, Nicola. Thank you.
Okay, so Nali, I noticed you came. Oh, hang on, Lisa's.
Oh, Lisa.
Yes, go, Lisa.
Hi. Sorry, I came a little bit late, but this has been brilliant. I've really taken a lot from what you've said. Just to, I can see that this is really going to help me to run my own business, but also to understand my client's business. But I think it's really important for us as either HR or L&D to understand where we impact and where we fit into all of these figures. And so our impact on how all those figures fit together, from delivering training and development or the things that we put into a business. And we come in at sort of overheads, don't we?
Correct.
So
yes.
So is there, I don't really know what my question was really now, it's just gone out of my head, but I think it's just understanding the bit of all of that, where I fit in as a person, as an employee, or the employees of the client, and you know where we're making those impacts, and we can actually now talk the language of our clients and the managers in the business to be able to generate more added value is really important, I think. So thank you very much, it's been really helpful. Lots to think about.
Excellent.
Lovely, thank you. Any final questions? I'm just reflecting, Ted. Yeah, you know, we had that conversation beforehand when I was saying, yeah, I can tell you what EBITDA stands for. I'm just bringing to mind all of the many financial presentations being given by various group financial directors over the year, and every single time they'll trot that out, EBITDA, and give us a figure. I think, why have they just not brought it to life by talking about controllable profit? That makes so much more sense, even just using that language slightly differently. Great stuff. Thank you so very much for giving us your time today. I'm certainly going to be hosting the recording on Thrivecart as usual. I'm going to link through to Ted's YouTube channel as well. There are some cracking videos on there as well, and also link through. So all of the links that you've got on these slides, I'll host there on Thrivecart for you. And so you've got easy access, because I tell you what, it's well worth topping up your knowledge with a bit of Ted. Thank you so much for your time, Ted. Really appreciate it.
No worries. Good to see you, Katie. Thank you very much, everybody. Nice to meet you all.
Thank you.
So I hope you enjoyed that video and found it useful and informative. Now, if you want to know more about what I do, then you can visit Talk Financials and find out about the training workshops and the clients that I work with. And the QR code is on your screen right now. If you are interested in being able to do this yourself, to do some financial analysis, there's a couple of resources. There is an online workshop. It's available on my website, or you can click on the QR code and it'll take you straight through to this online workshop where you can learn to read and understand and interpret financial information yourself. Alternatively, there is a book available at all good bookstops, particularly a very big online one, and the QR code once again will take you through to the opportunity to buy the book, and there is also a Kindle edition. Otherwise, that's everything from me. Please don't forget to like, share and subscribe to the channel. More subscribers means that you're going to get notification about new videos coming up, and also the opportunity to ask questions, and do recommend any videos any companies that you'd like me to analyze for you. I think we've got a couple of suggested next videos coming up, so please do take the opportunity, have a look at the other videos, and don't forget to like, share and subscribe to the channel, and I will see you on the next video.